Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.
This week on Wall Street Wrap-Up, the Consumer Price Index for March was released, and we'll tell you if the Federal Reserve raising interest rates were effective in fighting inflation. And bracing for the banks, Warren Buffett and Jamie Dimon said this week that we may not be finished with bank failures, and if not, then who may be next? Tonight, we'll find out just how stable regional banks are when we talk to the former deputy chairman of the FDIC and former CEO of IndyMac Bank, John Bovenzi. I'm Andre Laborde. We've got these stories and more. It's Friday, and it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up for this Friday, April 14th, 2023. Well, have you dropped your taxes in the mail yet? If not, please wait until after the show before heading out. But first, what did our money do this week and today? Stocks fell after a weak March retail sales report, and the Dow Jones was down almost 300 points at the day's lows. Big bank earnings boosted the financial sector, and J.P. Morgan, Citigroup, and Wells Fargo led the financials. And energy, this week, it was a winner. Real estate and utilities lagged in the S&P today. This week, the Dow Jones closed today at 33,885, and it was up 1.2% for the week. And the S&P 500, they closed today at 4,137, up 0.8 of a point for the week. And the NASDAQ, they closed today at 12,123, up 0.33% for the week. This week, J.P. Morgan, Wells Fargo, and Citibank released their first quarter earnings, and they were above expectations. Now, next week, though, many regional banks, including Signature and Silicon Valley banks, are going to be releasing their earnings for the first quarter. UBS has upgraded Goldman Sachs to a buy and raises their price target to now $385 a share. That's a 10% increase from what they had prior. So, now that we're into the month of April, how does this month usually look when it comes to a rising stock market? Actually, the month of April is usually the strongest, even ahead of December. According to Ryan Dietrich with the Carson Group and the Stock Traders Almanac, when the S&P 500 raises more than 5% a quarter for the last 2 quarters in a row consecutively, as you see this is what the S&P did perform the last 2 quarters, well, then the S&P 500 has risen in April an average of 13%, and it's done it a whopping 20 out of 23 times. Now, only 3 times since 1950 has the S&P been over 5% for the last 2 quarters, and the S&P 500 had not raised on average 13% in April. Now, those years were 1976, 1980, and in 2010. We'll see in about 2 weeks if we have to add 2023 to those last 3 years. The Bureau of Labor Statistics released the CPI numbers for last month, and it shows the Federal Reserve's raising of interest rates in spite of the government's dumping more money into the economy. For the month, inflation rose 0.1%. And year over year, since March of 2022, inflation is now at 5%. Now, it's not the 2% that the Federal Reserve wants, but it's much better than that 9% that we had just a few months ago. Let's get to our guest tonight. His name is John Bovenzi. He's the co-founder of financial and banking consulting firm, the Bovenzi Group, and he's also former deputy chairman of the FDIC. Hi, John. Welcome to Wall Street Wrap-Up.
Hello. Well, thank you for having me here.
John, this week, the NFIB, and for our viewers, it's the National Federation of Independent Businesses, came out with an interesting report. They found that about 30% of small business owners need loans from their lending institutions, whether it be a small regional bank or whatever, usually if not once a month, once every 2 to 3 months, they have to use a loan. And they found of those 30%, between 9 and 10% are finding it more difficult in securing a loan. Do you find this as a correlation? Is credit drying up and getting tighter to get from the small independent banks?
Well, I think credit's getting tighter to get in general. I mean, we're seeing the rapid rise in interest rates and the problems that we've had recently. And those problems are causing banks to be a little more careful in their lending. They're keeping more money in cash or short term securities so that if they need it, it's handy.
Well, is this because also of the failures with Signature Bank and also Silicon Valley Bank, that other banks are concerned that because of the fact that they're having a tightening of, that they went down, that more FDIC regulators are looking at them more stringently?
Yes, the regulators didn't do great with those two banks. I mean, there were obvious signs of troubles that were missed. Uh, so they're going to be a little more careful in watching banks right now to, make sure they're staying out of trouble.
Talking about, let's say, SVB, what they were doing was they had a lot of depositors. They were making a lot of loans, and with the money that they had, I'm assuming they thought it was good investments. They were putting them in treasuries, but with interest rates rising at the rate they were doing the last 13 to 14 months with the Federal Reserve, they were actually losing money. If you kept the bonds to maturity, you're doing fine. But if you need the money beforehand, you were actually taking a loss. So this created more of a vacuum of a problem. By banks going into treasuries rather than buying Enron stock or going into Bitcoin, were they doing right but making a bad bet?
Well, people got used to the fact that interest rates were so low for so long that they didn't appreciate that they can actually go up. And when you have inflation, they're going to go up. And so these banks said, okay, we want to be safe, and so we'll invest in government securities or mortgage backed securities. But they did it for like 30-year terms or 10 or 20-year terms. And so when interest rates went up to say 5%, and they're getting 2% rate of return on those, if they have to sell them, they're going to take a loss. And these banks also had a lot of uninsured deposits. And the uninsured depositors, if they sense some sign that the bank's in trouble, they're going to get their money out. And that's what happened in these banks. Silicon Valley Bank had lost 42 billion in deposits in one day, and the bank had to sell those securities, and they took a loss in selling them to get the cash to pay those deposits.
What about the future of small regional banks in this aspect? Because exactly what you're saying, coming to Silicon Valley Bank, they had $42 billion out in one day. And from what I understand, Silicon Valley Bank, contacted the FDIC the next morning, which was that Friday, and said, look, we're looking at about a $100 billion loss today. And through social media, through Twitter, through Facebook, how are banks going to be having to cope in the world of social media?
Banks are going to have to adjust. Bank regulators are going to have to adjust. There's going to be a very careful look at all around what needs to be done differently as a result of all this. And one area that's going to get attention is, the deposits that are at a bank. Banks are used to the fact that people were leaving their money in banks, even though they didn't get much in interest, because there were no real alternatives to get a safe investment with a higher interest rate. But now that interest rates have gone up, they're saying, wait a minute, I don't want to leave my money where there's no interest, and I'll move it. Banks are going to have to say, okay, we need to make sure that more of our money is insured, or we need to make sure we have more cash handy in case we start losing these deposits, or we're just going to have to pay a lot more for those deposits in order to keep them around.
With John, with the Dodd-Frank bill and others, I mean, larger banks had to have certain amounts of deposits, had to have cash on reserve handy, and smaller regional banks had to have less of that. So do you think this means that now regional banks will have to have more reserves on hand in the event of what you're just talking about?
Yes, I do. I mean, if you think of banks in three size categories, the very biggest that are over 250 billion in size, and the banks you're talking about more mid-range, 100 billion, 50 billion to 250 billion, and then there are the very small community banks. The community banks, most of the very small ones, most of their money is insured. They're not as susceptible to these kinds of deposit runs. But those mid-sized banks have an enormous amount of uninsured money, and they didn't have the same requirements put on them as the very largest ones did. And if you notice that the very largest banks did not have this problem, they had higher capital standards, higher liquidity standards, and were required to keep some debt that could be converted into equity if the bank got in trouble, which further protects their uninsured depositors. So it seems clear that it's going to be an easy step for regulators to say it was a mistake not to cover these size banks in the first place. We need to do it now.
What about the insurance of up to $250,000? Janet Yellen, Treasury Secretary, said that for SVB at least, that all deposits will be covered, including those over $250,000. Well, you had some deposits in one account of literally billions of dollars. Does the Treasury Department have that authority to be able to, one, cover that, or is it the FDIC, or will this now, once you start this as a precedent, will now other banks have to be insured over $250,000, whether they have $1 over or $1 billion over?
Well, only Congress has the authority to raise the deposit insurance coverage level above 250. What the regulators can do, if they act in unison between the FDIC, the Treasury, the Federal Reserve, and consult with the president, that's what the law says you have to do, all those things, they all have to agree on a case-by-case basis for an individual bank that there's a systemic problem, we have to protect everybody in this circumstance. The regulators used to have that authority, but after the last crisis in 2008, 2009, when they instituted these broad programs, Congress didn't like it, took that authority away from them.
So do I understand correctly that only Congress has the ability to, even for just SVB, of insuring all depositors? Does Congress have that one bank?
The regulators can do it on a case-by-case basis. So they can look at SVB and say, all right, if we don't protect everybody, this is going to create contagion effect, and so we need to do it. They can't do it across the board.
Well, from what my understanding is that in the FDIC insurance fund, there's about, give or take, approximately $130 billion that banks have been putting in continuously in the occurrence of a default, which has occurred. But there is over 130 billion that SVB is needed to cover all these even these uninsured deposits. So if all 130 billion is taken out of the FDIC insurance fund, where does the other money come from to just cover SVB alone? And we haven't even started talking about Signature Bank or others.
Yeah. Well, the actual loss that's expected by the FDIC on Silicon Valley Bank is about $20 billion.
Okay.
And so that's the number that affects the insurance fund. The other number is they may need to borrow some money, over the short term, and that will be paid back, that they will have the assets to protect that money. But the $20 billion is an enormous cost, and another $2 billion for Signature, $22 billion. And if you think about it, the 90% of the deposits in those banks were uninsured. If the regulators had not protected all those deposits, then 90% of that cost to the FDIC wouldn't have happened. And then the FDIC now will be out the $22 billion, will go to the banking industry and say, we're going to put a special assessment on all banks, maybe not all, but they'll put a special assessment on a good number of banks that had nothing to do with this, to raise that money back. And those banks will pass some of that cost on to their customers.
When I hear government officials and Janet Yellen and others say that the taxpayer will not bear not one penny of this expense, I mean, whether it be from NSF check fees to charges on bank accounts that have less than a certain amount of deposit. I mean, banks can raise fees to be able to, somebody's going to have to pay. Would it be correct to say that the depositor around the country is the one who's going to be funding this?
Yeah, I think that's fair. They may not pay 100%. Some of it may come out of the bank's profits, but the banks will pass some of that on to their customers in terms of either higher fees or paying them lower interest rates for their deposits. So,
does the FDIC maybe bear any, I'll say, culpability in this aspect? Because from what I understand, that the regulators had been warned prior to, like SVB and also Signature Bank, that they were putting their money into these treasuries, but as you just said earlier, that they were such lower interest rates that when interest rates shot up, they were at a loss. Should the FDIC have any type of culpable on this?
Yeah, I think all the regulators have some culpability here. I mean, there's three: the FDIC, the Controller of the Currency, the Federal Reserve, and they all supervise different banks in the system. But I think what happened was the world changing as you've described, with the speed of which things can happen. The regulators haven't adjusted to that yet. And my suspicion is they knew well about the problems at some of these banks and were going through the process behind the scenes to have the banks correct those problems. But the pace was too slow given, the way the world is operating now.
CEO of J.P. Morgan, Jamie Dimon, came out with his annual letter, and it's an open letter to all shareholders, and everybody can view it. And even Barry Sternlicht, who is the CEO of I think Starwood Properties, had said that there's probably going to be more failures of banks to be coming ahead in the future. Do you see that because if Signature Bank and SVB did these kinds of A loans and B investing in treasuries, that there are so many other regional banks that other shoes are going to be dropping?
Well, first, I probably should say that anybody that's got less than 250,000 in a bank doesn't have to worry at all, regardless of anything. And there are a lot of ways to, if you have more than that, to get it all fully insured by spreading it in different kinds of accounts. Some markets, we know commercial real estate, you're going to have sectors that'll have problems. Banks loan a lot to commercial real estate. And so there will be some banking problems. There will be some bank failures, but not a crisis, not a widespread situation where everybody has to get worried about their money because you can insure it, and there'll be limited bank failures. And that's why deposit insurance is there, so that people really don't have to worry about which of those banks is safe and which isn't. Their money's safe unless they've got a lot of it in one account, and then you're supposed to be paying a little bit of attention to what you're doing with your money.
As you were talking before, if you've got a personal account as you said, you're guaranteed up to $250,000. Now, if anything over $250,000, and you may want to keep it in the same bank, but open a new account, that now opens up to another $250,000. But to my understanding, and correct me if I'm wrong, if you're a business, it is the cumulative amount.
A business can say to its bank, I just want to do business with one bank, but I want my money spread around so that it's all insured. And there are ways that the banks can do that by working with other banks.
About 70 to 80% of commercial loans, property loans, and such are being handled by the small regional bank. But as you talked about earlier, if the credit tightening gets harder to achieve to get these loans, do you see a vacuum and opening up of maybe other type of loan institutions? And by that I mean what's known as BDCs, business development companies, or private equity.
Well, that's sort of happening already. As standards go up to protect the banks with higher capital requirements or higher liquidity requirements, it becomes more expensive. It's safer, but it becomes more expensive for the banks. And so in some markets, they can't really compete. We've already seen like residential mortgages. The banks don't do many of them anymore. If they do, they sell them. If you over-regulate banks compared to everybody else, the business just goes elsewhere.
To my understanding, John, about $80 billion, or about 30% of the commercial loans on commercial real estate, will be coming due toward the end of this year. And there are many commercial leases, and I'm thinking of New York City and other major areas that, because we've just come out of COVID, there's people still working at home and such that are unoccupied, that don't have leases. Are banks going to be able to roll over these loans? What do you see for the commercial real estate market coming up?
Well, some parts of the commercial real estate market, will have some problems. I mean, you mentioned the offices where people aren't going back to work. It's certainly one area. The banks would have to look at that more on a case-by-case basis. I mean, if you tell somebody to pay up and they can't, and you foreclose, you're not going to get your full value out of that in that circumstances. So they've got to evaluate whether that makes sense versus, renegotiating terms to make it a little bit easier for somebody to pay. But there will be some trauma in that market as these leases come due.
Do you see that a real estate problem may be coming in the near future if this happens?
I don't see a 2008, 2009 situation at all. I do see pockets of problems in different areas, and certainly commercial real estate is an area that the regulators have, pointed out could be a source of some problems.
About 2 weeks ago, Jay Powell, Fed chair, was talking about federal digital currency and how this is going to be coming into being now. And I'm wondering how closer we are to having a federal digital currency instead of the U.S. monetary policy we have now. And I'm also curious, do you think this is a good thing?
I don't think we're close to having that. There's a lot that needs to be studied and understood about the effects of a digital currency. But the government has to look at how it sets it up so it doesn't entirely disrupt the existing structure. So I see it as something down the road. I don't necessarily think it's bad, but I don't see it as imminent either.
John, I have a lot more questions, but a lot less time. I hope you come back.
I enjoyed being here. Thank you for having me.
Thanks, John. Well, if you have a question or a comment about the show, love to hear from you. Make it concise, make it pithy, and write us. And notice the new email address, andre@benacapital.com. So let's look at the markets heading into next week. But first, on this day in 1894, Thomas Edison introduced the peephole kinescope. What did he later rename it as? We'll have the answer in just a moment. On this day in 1894, Thomas Edison introduced the peephole kinescope. What did he later rename it? The motion picture camera. Well, do you have a wristwatch that's been maybe sitting in your jewelry box and possibly not using it? The growth of the luxury watch market for pre-owned watches has exploded. Pre-owned luxury watches are online now and selling for 2 to 3 times the cost of a brand new luxury watch. And who are the biggest purchasers of these pre-owned watches? The Gen Z and millennials. They make up the largest percentage of purchasers. Now, as a reminder, those who thought the record players with vinyl records had been gone as the way of the phone booth or the payphone, vinyl record sales have also boomed as well. So, let's have a wrap-up on Wall Street. Whole Foods in San Francisco is shutting down their flagship store this week. The company told local news outlets that it was due to crime and safety concerns. Officials at the San Francisco Whole Foods say that shoplifting, drug use of people, and the safety of their employees were cited as reasons for the closure. Whole Foods were talking about only opened up 1 year ago. It was lauded as the flagship store for all the Whole Foods when it opened in San Francisco. After just 1 year, shutting down because of crime and shoplifting. And Walmart opened their first store in Chicago over 17 years ago, and they've decided to close at least 4 of their stores in the Windy City. As in Whole Foods cited earlier, shoplifting and crime created losses in their revenues, and it was actually cheaper to just close the Walmart stores. J.P. Morgan CEO Jamie Dimon told all senior executives that managing directors must now be in the office 5 days a week. In a memo to staff, they said that a number of employees are not meeting their in-office attendance expectations, and that must change. After almost 80 years, iconic kitchenware Tupperware may be going out of business. The Massachusetts-based company said it's exploring options like massive layoffs and or selling real estate and other cost-cutting measures to try to keep the company afloat and seal in the freshness. And that's a wrap-up on Wall Street Wrap-Up. Well, do you trust the media? Is Walter Cronkite the last newsman maybe you had faith in? Join me next week when we talk with Steve Krakauer, former CNN producer and author of the Amazon's bestseller list, Uncovered, How the Media Got Cozy with Power and Abandoned Its Principles and Lost the People. Next week, author Steve Krakauer. And that's our show for this Friday, April 14th. My thanks to John Bovenzi for joining us tonight, but especially we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love and a productive week ahead. And now you can go mail your tax returns to the IRS. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.